Hello, everyone. Happy Tuesday and welcome to the Open right here on Public Live. Yes, I'm a little bit more chipper today than I was yesterday because it seems as though the markets might be trying to get back some of the tremendous gains, some of the tremendous loss that we had yesterday. But it is Tuesday, June 14th. I am your host, Corey Hale, and I am glad, especially that some of our regular listeners are back with us today. And I'm talking to you, Janice, Brandon, Tam, Quentin. Thank you guys for joining us again today because the markets move fast. That's why we're here, everyone, to help you start your day with the latest financial news. We bring you the Open. This is 15 minutes of the top headlines every weekday morning. And there are quite a few that we need to get through today. Let's dive right in, everyone. Stock futures, they are on the rise, looking to recover, everyone, a portion of Monday's sell-off that sent the S&P 500 and that nosedive into bear market territory. Right now, it does seem like we're going to have a modest positive start with the S&P futures looking to start up more than 17 points. The Dow futures looking to start in the green, up 83 points, and the NASDAQ futures with the same look as the S&P 500 up 83, same as the Dow, up 83 points. Now, if you guys were paying attention throughout the day yesterday, because it got real, as the streets say. I mean, at one point, the Dow was down nearly 900 points. So the S&P 500 actually fell 3.9%, while the Dow dropped 2.8%, and the NASDAQ slipped the most, nearly 4.7%. This is the first time the S&P has entered a bear market since March 2020. I think we all remember what started in March 2020. Yes, official lockdowns and the pandemic. And it's the fourth time the S&P has been in this bear market territory since the year 2000. So with that in mind, investor sentiment has been increasingly sour, to say the least, as recent inflation data from May show prices continue to rise, remember accelerating at 8.6%. And the Federal Reserve getting ready for another rate hike this week. Do not forget they're going to be meeting tomorrow. And in response, everyone, to the inflation reports that were out last week, the central bank now expected to raise interest rates by 0.75 of a percentage point. That's at 0.75. More aggressive, significantly more aggressive than the 50 basis points that was initially expected. If you're thinking, Corey, I didn't know the Fed could actually raise interest rates by 0.75 of a basis point. When has that happened? Well, actually, there was a little bit of history. It has happened before, but it's been a mighty, mighty long time because the last time the Fed raised rates by 75 basis points, that was back in 1994. And not to date myself, folks, but I was too young to be trading during 1994. However, we may see another 75 basis point rate hike in less than 48 hours. We will wait and see. Now, it's not just the traditional markets that have been rocked like crazy. We got to turn our attention to the crypto markets. They continue to be volatile after Celsius Network, a popular crypto lending platform, announced that it was pausing all withdrawals, swap, and transfers between accounts due to extreme market conditions. Well, how extreme? Let's look at Bitcoin, for example, everyone. The price still below $23,000 a coin and down about 27% over the past week. Ethereum slightly above $1,200 and has dropped a hefty 35%. I know, I see the crying faces. Stick with me, everyone. 35% over the past week. Year to date, Ethereum is down about 70%. Some market analysts, crypto market analysts out there are saying that we could be getting ready to enter into what they're dubbing a crypto winter, which I don't think is like the same way it was Winter is Coming Game of Thrones style, but it could be. We'll have to see what happens. We got to stick with the broader crypto market because Coinbase, you guys know that popular platform, it's laying off 18% of its workforce, which adds up to 1,100 employees. The largest crypto exchange in the U.S. says the move is in effort to manage expenses and will leave the company with around 5,000 employees. Meanwhile, JP Morgan downgrading Coinbase, saying the company will struggle to turn a profit during the crypto downturn, as some of the analysts are saying, the crypto winter. Game of Thrones, winter is coming. All right, with that in mind, everyone, we got to bring in our very special Tuesday guest. You know him, you love him, Sean Emery, Chief Investment Officer at Avery & Co. Sean, welcome back to the Open.
Corey, good morning.
Good morning, Sean. There's a lot going on, especially since the last time I've spoken with you. I'm going to step away from crypto for a second and just focus on the broader market. The S&P 500 officially entering back into that bear market territory yesterday. How long do you think this one is going to last, and how much worse, if it's possible to get worse, before we actually see a rebound?
Yeah, so if you go back in history and look at bear markets, typically you don't know you're in one until you hit that threshold, and then you go back to the starting point, and then you count your days back and say, okay, well, I guess how long have we been here? And we're roughly around 150 days into this bear market now, even though, again, yesterday was the first day in terms of actually clarifying it. And going back to like 1950, actually, that's right around the average where bottoms tend to form. We also saw a 3-day losing streak that was very excessive. And one that, again, if you go back into history, has signaled moments of bottoms, right? So the last time this happened, a 3-day stretch like this, was June of 2020. We all remember that to some degree. And then you have to go back to kind of 2008 and then a couple other periods that were stressful for markets as well. So look, there's some evidence that, again, from a bottom formation standpoint, if you're just looking at averages and going back in time, that we're near from a timing perspective. Again, we all know what the underarching kind of reason behind what's driving some of the moves in the markets. So we do have to get past kind of the fears around inflation. If they raise 75 basis points, is that a positive, negative signal? If inflation is the issue and we're raising by 75, I think the market, in theory, takes that positively, just given the fact that, it could potentially destroy some of the inflation issues driven by demand. So that's kind of the take on bear markets and some of the data around it.
Sean, would you say that this rapid resetting of expectations by the Fed, especially with these calls for the potential 75 basis point rate hike, that would actually perhaps help to explain the latest bout of stock market pain that we've been experiencing?
Yeah, like when fixed income, when bonds, when short duration kind of assets or long duration assets, when they move so aggressively in the fixed income world, that only scatters equity investors. So it kind of has that knock-on effect. There's a lot of investors out there, a lot of firms and strategies that are predicated on stable yields. And then when yields are moving around, it can send, or the lack of send positive signals into the equity markets, just given the fact that there's so many firms that rely on either using a treasury as collateral, and if that collateral is moving up and down sharply each day, it leads to selling of equity assets. It's much more mechanical from that standpoint. But again, I think what we're seeing now is with rates moving higher in the real world, meaning mortgages and some of the other components of interest rates, that it does open the door for the Fed to move, because the real market has already priced in a lot of rate hikes in a sense, and that opens the door for the Fed to move, just given the fact that it's already in the economy. And getting that out of the way, I think, does two things. One, again, it potentially solves or helps solve the inflation problem, which is the root of the issue today, number one. And then number two, it really allows the Fed, call it a year from now, have ample breathing room in the environment where, let's say, there is a recession or there is economic weakness or there is something where the Fed needs to act. It provides them that cushion that I think at least from us, if when rates were at 0 or 0.25, it gives them no flexibility if something that comes from left field hits the economy, and they have no room for, let's say, moderating rates in the environment.
It seems like there's a definitely tight rope that the Fed is walking right now. And I hate to bring this up. I call it the dreaded R word. But really quickly, do you think that what happened on Wednesday with the Fed decision could potentially raise the likelihood of a deeper recession?
Yeah, I think it's there's the R word, and then there's the D word, which is deeper. And I think what people are concerned are worried about is whether the recession, if there is one, it's going to be a deep one. And I think that's the important question is whether it can be deep. Consumers are still spending. We post a bunch of data out there on consumption. Today, Visa and MasterCard speak. They spoke last week. They're seeing strong demand or spending within debit and credit cards. So the consumer's in a decent shape for sure. And what that ultimately leads us to believe is that, if there's going to be a recession, it'll be mild. I do think, at least as of right now, that, a recession or just at least slow growth, 1, -1, +1, -1 growth in the economy is a good thing. We need some form of equilibrium where I think the economy can somewhat reset, get back to, not looking at, okay, what are we growing past stimulus? What are we growing post-COVID? Get back to a steady state, which does two things. It allows the Fed to be a little bit, more data dependent, really, but also it allows businesses to have better predictive tools in their arsenal, whether it's inventory. We saw Target and Walmart have trouble gauging the demand on like the big physical appliances and things like that. So if we get to a steady state, I think that's a good thing and a healthy thing for the economy. And it allows, again, the future, the next 5 years to be much better than kind of having this boom and bust cycle that we've been in the last 2 years.
All right, Sean, as always, we love when you come on the show and share your insights. Once again, everyone, that's Sean Emery. He is the Chief Investment Officer at Avery & Co. Thanks for joining us.
If you would like to see more content like this, subscribe to our channel and download the public app where you can listen to these sessions in live time.